Thanks, Jeremy. Next we've got Professor Hazel Bateman from UNSW. Hazel has researched superannuation and retirement for many years, and also CIPRs, Centre for Excellence in Population Ageing Research, was asked by the FSI to write something on retirement. So Hazel was one of the key authors there.
Okay, thank you very much. Yes, I've been thinking about superannuation for a long time, and I would probably say that I really applaud the emphasis on decumulation, and it's probably 25 years too late. So it would have been really nice to have this conversation in 1992 in conjunction with the introduction of the superannuation guarantee. Okay, so overall I thought the idea of this CIPR, that name has to change, a CIPR is a good idea, and it's really nice because it continues the guidance that's given to superannuation members in the accumulation phase. Sorry. So in the accumulation phase, we don't have to think about whether to contribute because we're automatically enrolled. We don't have to think about our contribution rate because we have a mandatory minimum contribution rate. And we have My Super, so we have guidance to help us get to retirement. And this is a really nice idea because this is extending this guidance through retirement. And retirement is probably, and the decisions we have to make there are probably far more complicated than the decisions we have to make in the accumulation phase. We're much more heterogeneous at retirement, and we're facing all sorts of different risks, and we don't know how long we're going to live. You know, we don't know our health status. We don't know if we're going to stay with our partners, but we probably didn't know that earlier. There's a whole range of uncertainties there. And the interesting thing in the Australian policy environment is we don't really have any international examples to follow. Because often when you're doing policy work, you know, you can say, what's the US done, or what's Canada done, or what's the UK done? But we're really in charted waters. And as many of you know, when you go overseas, people are interested in finding out what we're doing. And there's a lot of interest at the moment in finding out what we're doing in decumulation. So it's particularly hard here coming up with what should a CIPR look like, because we don't really have role models to use as examples. I know that the CIPR is called a pre-selected product, and as Jeremy says, it falls short of a default. But if it's a pre-selected product by a super fund, it almost becomes a default because it becomes an endorsement of that super fund that people should take that product. And in that regard, I think it needs to be really well designed. So you may say, oh, it's not a default, it's just sitting there on the menu, but it is something that the super fund is endorsing that people take. And just going back to defaults we know are really nice because if we set a default, then people actually do something. And people have lack of skills, they procrastinate, a whole range of behavioural reasons why people don't do things. And if we set a default, people actually do things. So endorsing this product, people will probably take it because that's the way behaviour works. And I think we have to be very careful how we design this product. Defaults are good because people stick to them, but defaults are also bad because people stick to them. And we have to make sure that we design a product that suits most people. And just looking at the academic research, the type of people who stick to defaults are often the people who are the less educated, less skilled, know less about things. Probably in the superannuation sphere, the people with less income, less wealth, the people who've been less engaged. So we have to be very careful in the way we design this. And just in that context, I don't think we can get away from the fact that people at retirement can't get away from the fact that they're going to have to know something at retirement. They can't just go through life and be defaulted into a retirement product and then hope that that's going to suit them. I think we have to face the fact, and this is related to the consumer outcomes part of the report, that there has to be some interaction with people at retirement. So people have to be informed, advised, whether it's formal advice or not, but people actually have to understand what this product is and what they're paying for and what risks are actually being addressed in that product. And I also think it's not just people who need to be advised, and this also relates to Chapter 4 of the report. The financial advisors need to be advised as well, because it's not clear to me the past year I have actually spent designing a course called Retirement Planning for Financial Advisors. I'm working with some of the financial advisors who work with Challenger. And it's not clear to me that many financial advisors actually understand these risks either. So are they giving appropriate advice to people? Okay, so what should the CIPR look like? In my view, for all of these reasons, it should be a very simple product. And as Jeremy mentioned, we often talk about a triangle. What do people want? Well, what do people need? They need a regular income. They need to have something that addresses the risks they're going to face: longevity, investment, inflation, health risk, and they also need flexibility for uninsurable events. And I think we have to be very careful with this CIPR to make sure that it's a simple product. It's something that's not too complicated, and also if it's complicated, it's going to be costly. And the last thing we want to do is for people to follow this endorsed product that's a costly product. As far as what sort of tailoring, the key thing I think that is important is account balance. So people at the bottom end of the wealth distribution, they're going to get the age pension. Now, perhaps we don't really want those people to take a CIPR. They get the age pension, they have a little bit of super, they don't really need an income stream. People right up the top can self-insure. So the people that we should be interested in are the people in the middle. Many of those will be getting a part pension as well, which gives them longevity insurance. So I've sort of been thinking of a whole range of things that may be important, whether or not they get the age pension, whether or not they own a house, what's their marital status. Things such as risk preference is difficult because who knows what people's risk preferences are, and every financial advisor will use a different instrument, and who knows what's going on there. So I guess my bottom line is it's a good idea, but I think it has to be very carefully designed, and it has to be simple, and if it's not simple, it's going to be expensive. Thank you.
Thanks, Hazel. Next up we have Richard Boyfield, who's a partner in retirement consulting at Mercer. And I've asked Mercer along specifically because they're a bit of a leader in developing some of the products in this area. Particularly more recently, you may have seen something called Lifetime Plus being talked about in the industry press. Anyway, I'll let Richard tell us all about it.
Cheers, Geoff. Yeah, so Geoff's asked me to really kind of cover off the longevity pooling aspect of this and what Mercer's done in this space. And really, I think it's sort of part of that is around the perception around longevity pooling and why we haven't benefited from pooling of that risk to date. I guess in terms of all these policy decisions coming out of the FSI, probably one of the things I'd probably try and highlight and bring to people's attention, which I think has come through so far, is that you can always find that small group of people who it's not going to be right for, who are going to be worse off. And they're the people who are going to get the newspaper headlines. And in a trust structure, that's what quite often puts trustees off being forward-looking and trying to make those changes, because they worry about not all members' best interests. But is that right, considering that maybe it's your usual sort of 80-20 rule, that you work in the basis of the 20% rather than the benefits of the 80%? So I probably just urge you to think about that when you're making these decisions and you're thinking about how CIPRs potentially might apply going forward. When we look at life insurance, car insurance, etc., like that, pooling of risk, we tend to think is just a natural thing to do. A lot of people, particularly car insurance, and I'm sure there's a few bad drivers around here, but I'm sure there's good ones as well, who quite clearly will pay way more in premiums over the course of their lifespan than they actually receive from covering the cost of the accidents. You might have noticed the accent, and being an actuary as well, can't resist actually talking about a defined benefit pension scheme. One of the key things around that is, I'm sure some people still do remember what they are, but effectively they pool risk. They're all about pooling risks, and yeah, there are other issues about why they're expensive, but the one thing I'd draw out from that is that there's it's not very often challenged on a DB scheme. Most people put their hand up and say, yeah, I want one of those, thank you very much, give me a pension for the rest of my life, that'd be great. Very few of them start saying, well, hold on a minute, I might be one of the people who's going to die early, and hold on, what happens to all that money that's in there? They're not really, you very rarely get that, okay? But it's pooling, and it's the same thing, and it all really comes down to the framing then. They've been told throughout their lifetimes that they're going to get a pension in retirement of X, okay? They're constantly, that is their expectation. Then the thought of actually having to give up the pool of money, it's not as big an issue for them. So it's about the framing and, you know, provision of income statements in the Australian market has been talked about quite a bit, and obviously that would be beneficial to start people again in the mindset and the overall pooling in order to generate the benefits which are referred to in the FSI report. So in terms of CIPRs, framing's an issue. So first thing maybe, let's find the right name. Jeremy tells me he's already on the case, so we'll see what he comes up with. But the other thing is also this aversion again. So it does need to be opt-out to start off with, because again, it's a kind of soft compulsion. It gets people moving the right way. It maybe helps trustees go down that path of putting CIPRs in place. Maybe there also needs to be some kind of safe harbour for trustees as well, that again, maybe APRA approve the characteristics of these products in order to be able to then say, okay, gives the trustees the confidence to put them in place. We'd also probably suggest that, yes, one size is not going to fit all, so maybe you do need a few different products there, even within the one fund, more than one SIPR. You know, those on low incomes, the longevity protection probably will come from the age pension, and those people on the really high incomes, they may well not be applicable for them to have too much protection because they'll do it themselves. So we would support SIPRs. But we would also support that there's a need to actually frame this to get it to be accepted by the wider public. So what have we done in order to try and do this? And given I've focused on framing, getting an actuary to come and tell you about longevity pooling and get it to be accepted by the general public is maybe not the best idea, I suppose. That's why, in terms of Mercer Lifetime Plus, if you go to our website, I encourage you all to do so naturally, you will find non-actuaries talking to you. You'll find videos, you'll find information which have been developed by the people to explain this to you. You'll meet Martha and Alice, etc., who'll talk to you why it works for them, why is longevity protection important to them. But if I just bring out the key elements of what we've done. So we've tried to work within the existing framework that we have. That's a big challenge. All my suggestions when we were brainstorming this in the first place, I just got a whole page full of red remarks as to why that wouldn't work due to regulation. In my defence, I would probably say that I'd only been here 3 months at the time, so I probably understand that a little bit better now. But all credit to David Knox, who managed to work his way through this. The key elements then are to keep it within an account-based pension. So the Mercer Lifetime product is an investment option. It just fits into an account-based pension. So again, in terms of that ability to get it across to people, most people take an account-based pension. Having it as an investment option makes it understandable to them. Okay, so how does that fit? So when you get to retirement, people will tend to have a diversified portfolio. So they'll have growth assets, they'll have balanced assets, and they'll have some more conservative and cash elements. So what we've done is said, oh, okay, well, if we can just replicate that conservative cash element, give you a return of cash plus 1%, low probability of negative returns, and add on longevity protection for you, well then to most people, if you go along to them saying, okay, it's your same kind of structure, your account-based pension, plus if you actually live longer, you'll get longevity protection coming in from continued increases in the payments that you get. It kind of works for most people. That's okay, that's great, okay. They always ask what the catch is, because obviously you don't get anything for nothing. And then that's just back to this point that I mentioned at the beginning. It's this perception and the ability to accept pooling of risk. So the major thing there is, okay, so you continually get an interest payment each year coming into your account-based pension. The thing that actually starts to then generate and give you that increases as you live longer in life is the fact that those people who haven't survived, they're going to start to drip some of their initial capital back into the fund, which is then redistributed to you. So you've just got to be willing to give up some of that capital in the event you're not one of the lucky people who survives until they're 100. But again, because people do have this aversion to, oh no, I'm going to give up all my capital, we have just designed it so that initially in the early stages you get 95% of your capital back on withdrawal or death. And then that only actually starts to decline once you get past the ages of 75. Okay, so it covers off that risk aversion that people have. So hopefully we've managed to cover off most of those issues and help support and put something that can be framed to the general public that they will accept. Okay, thanks, Geoff.
Thank you. tried to think of an acronyms. What about retirement income products? Why didn't we go with that? Think about it. Craig, did you want to add something? I saw a raised eyebrow there. So
I thought the contribution from all three speakers was really valuable, and I mean, hopefully the report will achieve more than just in this area, but the fact we're now all sitting around and talking about this and thinking about potential solutions is a real improvement for a system that's been, for understandable reasons, sort of very focused on accumulation and not deaccumulation. And I'm in awe that Hazel can say homogeneous and heterogeneous so quickly without stumbling. My greatest fear was giving speeches in this area and having to get my mouth around those words. But I think they were really valuable contributions, and I think it's not an easy space. It is complex, and the report deliberately only went so far because of that. And I think it would be great if, on the longevity risk issue, that we are able to get a market solution to that space. And I thought Richard's comments on how we frame that was really valuable. Now, I know it's not the same as other insurance markets. We do have a government backstop called the age pension, and that can complicate things and has significant impacts, and as sort of Hazel was alluding to, makes it more complex and different people will be in different positions. But I sort of think there is a solution there for longevity risk, and I think as you get more people going through that, that's one of their biggest concerns, about not knowing how long they're going to live and how they're going to provide for themselves. And I think if we're going to hold ourselves up as a high quality, world respected industry, we've got to address that.
Okay, thanks, Craig. I might open up now for additional questions or comments from the floor. Just identify yourself and...
John Freeburn, University of Melbourne. You discussed the issue from the point of view of somebody retiring. What also seems to me important is from the point of view of the companies providing this product. What if they go broke? Is there going to be a backup for them? Does government then create moral hazard problems? It seems to me that issue is at least as important.
I'm wondering who might want to take that up. I mean, I was thinking there was a natural person who must have fielded this question 50,000 times by now.
Look, I suppose the answer is that the providers of these products are not ordinary companies. So really the two models that we can see emerging at the moment are life insurance companies providing the annuity or variants of that product, and they are heavily, they're little understood, unfortunately, because of what we've done with superannuation over the years, but they are backed by shareholder capital and prudentially supervised by APRA. They are not ordinary companies, and indeed the Life Act actually assumes that they'll go broke. And that's why it creates a thing called the statutory fund, into which your premium and additional shareholder capital is placed and protected by that supervisory framework. So that's the answer to that question on the life side. Then there are super funds, and similarly they're prudentially regulated, although in a different way, because they've been traditionally regarded as less dangerous because they're unleveraged. Most prudential regulation is around supervising leverage. So the sorts of entities that are going to be offering these products into the market are not just ordinary companies. People talk about counterparty risk. I think with these sorts of things, it's more a regulatory risk. There's either something we just don't know about that's going to happen, or something fails in the regulatory space. But just to give you an example, in the life space, there has to be enough capital and risk weighting and so on to deal with a 1 in 200 year event. That's what APRA, that's its guideline here. The GFC was typically and globally regarded as a 1 in 70 year event, and no life companies had any problem during the GFC. None of them needed to raise capital and so on. So that 1 in 200 standard is very little known, but extremely beneficial, and I think APRA's relaxed and looking forward to this market taking off, because it believes that setting will be sufficient.
Okay, thanks, Jeremy.
Hi, I'm Graham Henn from the Cufflinks newsletter. Actually, Jeremy's paper on this subject is being published by us this week, so anyone wants to read more detail, get on board. My question is, a couple of weeks ago at the SMSF Association conference, Helen Ralph from APRA said that there are now more than 40,000 products being offered by APRA regulated entities. And I got a very clear impression from her that APRA considered this totally unacceptable. It was affecting the efficiency of the system. And you know, we've obviously had My Super recently. Jeff's just talking about tailoring CIPR. We've had a number of solutions here on CIPR. How do we stop this becoming just product proliferation, totally confusing to people other than those people in this room, and actually potentially not the step forward that we hope it's going to be?
Does anybody want to take up the challenge?
I'd just like to make a comment on that, and it comes back to the point I said earlier about My Super and choice products and the fee disclosure issues as well. AIST has certainly submitted to APRA on the data reporting side and ASIC on the fee disclosure side that they should be treated on an equal playing field, because there are 44,000 member investment choices, and that clearly shows that that's not member driven, it's actually supplier driven, and that's adding to the inefficiency of the system. So that's my response to that.
Perhaps Craig, I'd counted them once. So on the super menu for AMP, for instance, there's 110 products.
Right.
Why do you need 110? Can you, from your memory of what?
Well, fortunately, I can't speak for AMP anymore. So,
yeah.
Look, I agree with the issue. There's probably almost too much choice in one area, in some areas, and Inquiry did make a recommendation on trying to deal with legacy products, and I think that I haven't seen Helen's data from APRA. I think it's a really good question, and agree with the proliferation of product in the choice market. But the problem with financial products, as we know, is they don't, until the last person uses them, they don't. It's not like a car, to use the analogy before, where so they go to the wrecking yard and they go away. These can last for a very long time. So I think we do have to get our minds around, as a community and industry, how do we deal with the legacy issue of products, and how do we try and consolidate those? And there's tax issues involved there that we need to get right with the government, but there's also this test, which is a high hurdle, that effectively almost every person in the product has to be at least as well off if we move to a new product. And I think Richard was sort of getting to that point before in designing new product for trustees. So we have to get our minds around how we deal with that legacy issue.
Mm-hmm. Certainly. I think we have time for one more question or comment. Ross.
Ross Clare from ASFA. It's a question for any of the three on the panel, but maybe Richard could be a first starter on it. In terms of the market for longevity products, how big is it? At the top end, the rich people are often interested in estate planning, and they're not all that concerned about the money running out. They want to make sure that there's some left at the end. At the lower end, the people don't have very much money, and there's the age pension. So how big is the middle market, and what penetration rate for longevity products do the panellists think there might be?
Sure, thanks. I think I think you rightly identify, we probably look at it at a broad level, that there is probably those three segments overall. Within the Lifetime Plus, we do suggest that it's not going to be for everyone. Again, as we say, you're going to need more than one product, particularly those at the lower end. Longevity protection is probably largely going to be provided by the age pension. At the top end, people will probably be capable of actually managing that themselves, because they'll probably have surplus assets overall. But if you think about it, that group in the middle is probably where a lot of people, and probably a lot of people in this room, will end up falling when they get to the point of retirement. And that group is probably anywhere from people over a couple of 100,000. We quite often actually do our examples for people at 400,000 as their pot at retirement. But you'd need to get over 1 million at least, I would think. I'd probably suggest it's probably a lot more than that in terms of a pot. Before you start actually getting comfortable that you can manage that longevity risk yourself, because that longevity risk is very broad. You know, with all the statistics in terms of how long people are living, you know, we've got over 50% of females expected who are currently 65. We're expecting them to live beyond 90. That's a large variation, you think, between 65 and possibly going, you know, into the hundreds. A large volatility for you to manage. So you're going to need some big pots. So the market is we would think is quite large. Obviously, we wouldn't have started to try and develop products if we thought it was going to be very small. I'm sure Jeremy is the same challenge. Obviously, you know, there is a big market in that space that we think it would apply to, for sure.
There were two really, you know, there were many useful things in the FSI, but two in the final report, two really interesting ones in this space. The first is that 1 in 10 of the 65-year-old women today are going to live to be over 100. And the second one was that people just can't understand, you know, of all of the panoply of complex things in this subject, that, you know, longevity risk is probably, you know, right in the centre. So it's going to be a matter of intelligently designing. It's not as if people are going to be rushing, you know, through the doors of Mercer or Challenger for these products necessarily, but the good design of a CIPR will, by it being a quasi-default, encourage them to be in the product and to take the benefit of whatever longevity protection is in there. So I think potentially the market is very large.
Okay, well, I think we better call it quits on that, and we will now move. Pauline will now take us through tax.
Now, the hottest topic is always the last topic, isn't tax? Tax and super, big conversation. Just like the other topic on efficiency and competition, it is important to get the facts right. And there's a lot of discussion and figures put forward by various commentators, regulators and Treasury on where the tax concessions go and the cost. So the big $30-odd billion cost, we don't agree with it. It's about $16 billion when you actually price it properly. And in terms of where the concessions go, on the contributions, certainly the tax concessions mainly go to low to medium income earners. In terms of earnings rates and the concessions around there, it goes to medium to high income earners. But what is important to understand is as we go through this debate and the tax issues papers hits our desk, everything is up to grabs. But for today, the panel has been asked to consider 2 issues, and they're in front of you there. And the first person to consider those issues is Michael Weiss.
Thanks, Pauline. Before we can get our system stable, we've got to agree on broad tax principles. We've had almost annual changes since the introduction of lump sum taxes in 1983. It's good for consultants and lawyers, actuaries and the like, but not very good for the consumer who's quite baffled by everything. Now, I think, and in addition to that, retirees face the problem of dealing with the age pension, which is means tested and which they know very little about, and that gets tinkered with all the time as well. So the only way we're going to get some stability is, firstly, we need bipartisan support on this, because if one party introduces something, the other will cherry pick, and they're always winners and losers, and they'll focus on the losers to win votes. And the other issue is that balancing the federal budget each year is a real challenge, because there are 2 big items. The tax concessions, which Pauline just mentioned, they are overstated, but they're nonetheless still large, the largest concession given after the lack of CGT on the family home. So the government knows that if it's trying to balance a budget, and when you've got a deficit that becomes more important, then it's got to deal with that. The second thing is the age pension is the biggest expenditure. It's $41 billion and it's going up to 50 in 4 years. And so that's an issue. The issue the government has, though, is these are from different generations. Can't do much about the age pensioners because they've already retired. So it's got to try and work out how does it make the concessions efficient so that it can reduce age pension expenditure in the future. And frankly, when you look at the IGR report, it's not really doing a good job of that because we're not reducing dependency fast enough. So addressing the 2 questions in the context of that, I personally think it would be beneficial to tax the earning rates of retirement assets at the same rate as accumulation funds. Apart from halving the number of unit prices we have to deal with, it would make the system a lot more simple. you would, for example, get rid of the gaming that SMSFs use, where they never pay capital gains tax. I've had an SMSF for years and I've always had a tax rebate. Buybacks in accumulation give you losses that are carried forward that you can use, and then the moment you retire, all your deferred capital gains voided. If you had the same rate of tax throughout, that wouldn't apply. It would cost me a lot of money. If you taxed it at 15%, the government would actually make money which they could then use to introduce other concessions in super, like making the LISC more permanent for low-income earners. But if they were equitable, because there are 30% of assets in the retirement space, the pension phase already, they could just tax the whole system at 10.5%, which would give a windfall for the accumulation members, at least in the short term. And as the pension assets will grow to about 40% in 15 years, they could drop that rate theoretically to 9%. Now, governments aren't used to dropping rates when they've got deficits, so they'll probably keep it at 15%. But nonetheless, it would be more equitable. I would supplement this by looking at the tax on death in retirement. We have death duties for those people leaving their benefit to non-dependents. It's 15% on the concessional part of the benefit. I think all of the differentiation of where the money came from is irrelevant. I just tax the whole lot at 15%. I think once the money's in the system, it's concession. It doesn't really matter the source of it. And that would eliminate all these inefficient recontribution strategies that people in SMSFs use. So you've got to transition to retirement pension, you've got to draw 4%, you don't need the money, you put it back as a non-concession, and that eventually reduces future taxes. So the second question, what do we do about super tax concessions? The current rate of $35,000 for older people is about 50% of average earning. I don't know whether that's good or bad. It seems reasonably fair, and it could be capped or linked to that in future. I think for people who've got long-term good savings habits, not many, but there are some, that would be sufficient. So the issue is really, how do we deal with people who want to catch up late in life and get them to contribute more because they've spent their money on other things as in their earlier years, like education and mortgages, etc. So the option there is, there are a couple of options. You could have lifetime caps, which I know ASFA is in favour of. The transitional arrangements would be messy for that, because what do you do with all the people currently in the system? But another way is to say to people, link it to the amount of money they've already accumulated. So you could say for people over, say, 50, if you've got less than, for argument's sake, $500,000, you could put in 15,000 more. So your cap would be, the contributions would be 50 rather than 35. So there are simple ways you could do it, recognising that governments will play with those numbers from time to time. And then the last point I'd like to make on tax is that you have to look at the integration with the age pension. The means test is grossly inefficient. Somebody with 1.2 million in their super fund who rents will get no age pension at all because of their assets. Somebody with $1 million house and 200 grand in their super fund will get a full age pension. And a pension to a married couple's got a present value, 65 for a couple of about $800,000. That's a lot of money to give away just because they've structured their asset base differently. But what do you do about this? Because if you bring the family home into the age pension test, you open a political can of worms. You'd have to grandfather it, which would mean that the benefits would take a long time and you'd miss the baby boomer generation. So it's just not easy to resolve. And I think this is the big problem that governments have, is that tax is very complex. Thank you.
Thank you, Michael. And just, was excellent. Thank you. Maybe we should get people to pull the money out of super if they've got over a certain account balance. Anyway, let's add that to the conversation. Adrian.
Just a quick survey on the married men in the room. Who's got the best wife in the world, they reckon? Show of hands. Sorry, guys. I do. Today is my wedding anniversary. I'm based in Melbourne. right? So not Sydney. Okay, there's a variation there. So I already got one black mark. And the last few weeks have been going following the Irish cricket team, including yesterday in Hamilton as well. So I didn't even see her this morning. So she's an incredible lady. So I just wanted to make that announcement. I hope that's taped as well, is it? Good. Love you, darling. Okay. So why am I here? I'm actually passionate about self-managed super funds. I've been an accountant, I've been an advisor, I've been a registered company auditor, a member, a trustee, and I did a PhD and subsequent research on self-managed super funds. And I'm only going to focus on these questions on the self-managed super funds rather than the large APRA funds, mainly because it's the biggest segment, and rapidly growing as well. Yeah, I agree there should be same tax rate, pre and post. 15% is what the concessional tax rate. But in reality, for self-managed super funds, in terms of my research, the average tax rate a self-managed super fund pays is only 6%, not 15%. How does that happen? Franking credits. They get franking credits of 30%, and so they reduce their overall tax to pay. So that's something to be considered, in terms of the policymakers and the like. We're not talking about it's going to be a 15%. It's going to be roughly 6%, all the things being equal. And the financial planners and the tax advisors may even up that as well and say, well, okay, have a heavier weighting to shares in these self-managed super funds, and yet especially in the allocation phase as well. So you even get get the refunds back as well. CGT on unrealised gains is a huge problem. It's a huge differential that has to be corrected. People are not selling their assets, waiting till allocation, flicking the switch to allocation phase, and getting it tax-free. So there needs to be some differential. Maybe at that point that you flick the switch, whatever your unrealised gain is, you get taxed on it, is included in your taxable income, or some variation, or it's just taxed normally. Financial planners, they do statements of advice, and they do calculations. There's calculations going ahead right now, and they say, Joe and Mary, if you put so much in and from now until retirement, you work out till you'll reach your income goal of $14,882 a year, whatever the magic number is. If we start taxing in retirement phase, all those calculations change. So what does that happen with the self-managed super funds? They will still want to get that $14,000 figure, that magical figure. They're going to increase their risk to get a higher return pre-tax. Now, are we concerned about actually, making a secure third pillar? But if they're increasing risk, we risk losing the lot, do we? Now, we do have a put option in there in terms of, with the age pension. If you blow the loss in terms of your savings, you can fall back onto that pension. But do we really want to take that risk in superannuation, particularly what the design is with the objective? Also, you have to, we're talking about grandfathering. So is there any transitional requirements are going to go through, even just with retirement income products before? What happens if it's made compulsory? That is, you can't take a lump sum out. You can only draw a certain amount. There's a lot of people there with self-managed super funds, or even outside in normal superannuation. They're making an investment strategy or putting in the maximum contributions amount, not paying off their home loans until they retire. So the first transaction they do when they retire, take the lump sum, then pay off their home loan, right? How's that going to change? What's the impact going to be? Tax concessions, I agree. Forget about this $35,000 a year amount. Maybe have a lifetime contribution limit. It may be tinkered with because some people may take advantage of it. But you think about sportsmen and people that have unusual income levels. There's only a certain time of their life where they earn high amounts of money. When they're limited to only being able to put in $35,000 for those years, and then post their higher income earning years, they can't do it. Cool. I've got 4 hours. Good. But maybe perhaps having marginal tax rates in relation to superannuation as well. We do have that with Division 293 that came in terms of contributions for high income earners. But those high income earners are taking advantage of, okay, well, only 1 year out of 4, they'll earn over $300,000 because they generally run their own business, right? So they're able to take advantage of that situation as well. but we're taxing their contributions, but not their earnings. So that may be something else to think about. So plenty of other things to talk about. Happy to share with you later, including the cricket. Thank you.
Thank you, Adrian. Okay, we've got about 8 minutes to nail it, to nail tax and super. Who's going to start? Now, Graham, you've heard a bit about self-managed funds today. Are they really just a tax avoidance vehicle? I'm not going to let you sit there and not comment.
I was trying to remain quiet, but
I know.
I mean, the misconceptions about self-managed funds are just a naive understanding of the tax system, because large superannuation funds have got the same opportunities as the small funds. That movement from accumulation to pension phase and abuse of whatever the concessions are for self-managed funds there is just a myth, because the large superannuation funds use exactly the same techniques. I've used recontribution strategies through large superannuation funds, of which I'm a member, so I think it's universally available. There are one or two concessions there that the larger funds have got over the self-managed funds, but basically they're the same for that. So that's my opinion on that.
But let's go to the threshold question. You know, super shouldn't be a tax avoidance vehicle. Are we all sort of on keen with that? Yeah, we're all keen with that. That there should be some tax concessions to compensate for people putting their money away? We all have...
Well, I think if you look at different savings, you can put money in your own house, and even in your retirement you can get a bigger and bigger and better house, not $1 million one, a $10 million one, no tax.
Absolutely.
So super being zero tax is equivalent to that. If you earn up to 35 grand in a bank deposit or shares, that's also going to be zero tax. Yeah. So you're in a hybrid cock-up mess that we've still got in the accumulation stage. So I think if you're really serious, own homes do have to come into the story. And I think, you know, the proposal that we're given of a 15% continuation is still a hybrid mess without the adjective in front of it.
I agree, thank you. I think homes are definitely on the agenda. Over here. Now, can we share the mic?
Sure.
Thank you.
Charles Sanford, I always think that the idea of a reverse means test is one of the most bizarre inventions of the tax system, and that the richer you are, the more tax benefit you can get, or the more benefits you actually get. I think that it's basically bizarre, and I think what's interesting, I'm reasonably well off, and I went on a cruise, and there was somebody who was much more well off than me, and he was actually talking to me. He had huge houses in Toorak and everything else, and he was very, very conscious of just how unfair the superannuation benefits were, and I agree with it's actually not SMFs and others, it's just these tax benefits. He realised how terribly unfair, and he basically asked me, he said, when people realise it's completely unfair, what are the transition arrangements going to be? Basically advising him about you know, crystal balls and what. And to some extent, I think the FSI was really good in saying, well, really, sort of, how much does it cost the government? And first article I did in tax in 1990, I worked out that it was cheaper then to pay everybody the pension and get rid of superannuation concessions then, without all the things that have changed since. And I think that we just have to say, in a sense, if in fact the government has got an obligation to give the pension, and I think what's really important about the longevity thing is that actually, if you're doing superannuation, it's not as if you're buying out of the full amount of that future future liability. And I think we've got to the idea of saying, well, actually, how much does it cost how much does the government save because of the not doing the pension, and basically start setting the total tax benefits. And tax benefits take a number of different ways, and I think that, and so basically once you get to that level, you don't get any more tax benefits. And I think that that would do a lot of grandfathering. Okay, so you've done really well in the past, but it's not that you continue to do exactly as well as you expect to do. Nobody. I wrote a book on retrospectivity. That's not. It's not retrospective to say that the benefits you expected to get in the future you won't actually get. And I think we've got to just sort of compare how much does it cost in superannuation concessions, how much pension does it save? And it is irrational, unfair for a government to have a reverse means test and actually give people more than they are saving.
And I think you're right. The active discussion is really what is the ceiling? What should the ceiling be? We've said, look, anything above 2.5 million should be up for grabs, and let's transition to that. But it is a very difficult conversation. Any other comments, questions for the panel in particular? Ross?
Both the panellists spoke about the desirability of having the same tax rate in pension as in accumulation. We don't have that many incentives anymore for taking income streams. The social security treatment is much the same outside of super, and for many low-income people in retirement, their tax rate might be 0 or less than 15% on average. So if we went down that path, would there be a need for some sort of incentive to take income streams, or would you just have a situation where those on lower incomes wouldn't go there because there was no tax advantage?
Ross, if you look, people with small balances at retirement, say under 100,000, generally take the money, spend 20,000 on a car or a new kitchen, and the rest goes into a bank term deposit and it's tax-free. I think that's a reasonable choice for them. The challenge for funds is to say, can we get somebody with $150,000 and deliver a return after tax, reasonably low rate of tax, that will be better than a term deposit and will keep them as a member. But if you look at, and I think it's Mercer, it might be one of your competitors, I've seen the little chart that says that your end benefit over your lifetime, including pension, about 10% of it comes from contributions, 30% from earnings up to retirement, and 60% is earnings during the retirement years. And the thing that we're doing is we're getting people to build very large balances, and we're not taking any tax off them at all. The biggest SMSF, I think, has got 300 million in it. And that person will, he should be, if he was paying 15% tax, he might pay 4 or 5 million a year in tax, and he might get another, 30 million off him when he dies. But is the purpose of super to give that person a permanent free kick? And they can take all the money out before they die and avoid the death duty anyway. So I just think, I think an equal tax rate will collect more than the damage it does to the low-income people who've got a choice.
Yeah. Now, clearly the issue is that there are issues to fix up now, because we do have some accounts with millions and millions of dollars, and others that are not nearly there and never will be there. So one size will not fit all. Now, we've got time for one more comment question for the panel.
I'll just make a quick one. I just think the US solution to this was quite interesting. So when we had the spectacle of Mitt Romney's $100 million 401k plan, the response of the administration was to say, well, at the 3 million mark, money above that is no longer qualified. That's American language. It's not superannuation anymore. It's just ordinary money, just ruling a line through the system. I'm not advocating that. I'm just putting it on the table.
I think it's time to make those decisions, and you'll all get your opportunity when the tax issues paper comes out. So look forward to hearing. Over to you.
Okay. Thank you, Pauline, and thank you for all our panellists. I know it's been a very quick session. You know, these issues you can spend a lot more than 5 minutes on, and you can spend a lot more than 2 hours on those 3 topics, but hopefully you all got something out of it. I had one question, and I need not get an answer to this right now, but one of the things that always entertains our mind at CIFR is, you know, what questions, research questions are there out there to be answered? And even beyond the existence of CIFR, there's a few academics in the room that might be interested in that. So I'd like to open up to say, does anybody think there's any burning questions in the super and retirement sector that could be answered by academics, bearing in mind what academics are capable of doing? Does anybody? I didn't actually expect any hints. Now, do I take that as there's no research questions, or I take that I mentioned the word academic? Oh, Adrian, but you're an academic, Adrian.
Yeah, I know. So this is actually a request of those in industry. I would like to have the availability of the data, being the full audited financial statements of all of the large APRA funds, for us to be able to conduct some research. Most of the super funds is very protected, very hard to get the information even requested, and they say it's, oh, you need to be a member and the like. I would like it to be open, available data, particularly when the top 500 private companies, 7 of the top 10 are effectively super funds, and so it's such a huge industry, such a huge influence on the Australian economy, and I think for us academics, we need to have that data, and even particularly around related party transactions when it comes to fees as well, because I think there's a lot of smokes and mirror when it comes to the reallocation of fees and that whole fee debate.
I might just respond to that. I will respond to that. So the data collection from the industry over the last year and a half has increased from 300 pieces of data to over 3,000. A lot of this is provided on a monthly and quarterly, and some of it on an annual basis within very short timelines. That collection has started. It all goes to APRA. The intention of APRA is to make all of that data public, every single piece of it. Now, the issue at the moment is that, like any start to data collection, you have to, there are sort of issues with the way in which the data is collected, the way the data request is being interpreted, and that is certainly an issue for APRA and the industry at the moment. So there isn't a great deal of consistency. There is certainly some issues on the forms not reflecting the very different structures across the industry. So what I'm saying is be patient. We have a great concern about putting out bad data, because as we've seen, data can be misinterpreted and it causes a lot of damage. So the aim is over the next 2 years to get that data out, to get it collected and analysed electronically, so that the industry will be more transparent and accountable.
Okay, thank you. Karen.
Yes, back in 2006, APRA did a survey of funds, which the data of which is not in the APRA reporting, and they released several, addressing Adrian's point, several papers back in 2010 regarding fees, concentrated markets and related party transactions. So that data hasn't been updated for some time, and I actually think that's a very good piece of work that could be done and updated. Admittedly, it is reliant on a survey of funds and their willingness obviously to participate in that, but still it's a very valuable piece of work.
Okay, thanks.
One research question, I've got no idea how to answer it, but it's a substitution effect, and that is that I think one of the few arguments I've had for the generous tax concessions for superannuation is that actually people didn't evade and avoid tax in other ways. And so, and one of the interesting things, counterfactual things, how much in a sense of the generosity of the tax concessions, which I've criticised and still do, but how much of that actually became substitution, and also if we eliminate it, how much is it going to go into other tax minimisation, evasion, avoidance schemes? And I think that it's something to be realistic about it. It doesn't mean you don't aim for good policy, but also it means that you try and get some idea. Asking the first question may help you answer the second question, because I think we may find that there's less savings because we're driven out into other things, and the other things may actually be worse.
Yep. point taken. Very good point too. James.
Geoff, I think the Murray inquiry really puts a strong emphasis on researchers now to evaluate the effectiveness of the new MySuper regime, doesn't it? Because we've got that, and the stick that's hanging over us is that the possibility of that national default option. And so the Murray report is asking us to respond to that by 2017 to whether MySuper is working and improving in efficiency and value. And yeah.
Yes, agreed. Well, thanks for that. If anybody has any post comments about research questions, I'd be very happy to see them. I would just make one passing comment, is that ideally research should start with a research question, and hopefully a research question that people are interested in and is valued. But to be perfectly frank, data does drive research. You see it all the day in academics. As soon as a database becomes available, academics crawl all over it and they produce research. So provision of data, which APRA is working towards, is to be welcomed in that sense. And it is the thing that's been sorely lacking. If you wonder why so much research is out there about US mutual funds and US stocks, it's because there's a really easily accessible database and a very deep one out there. So I think with that, we'll call it quits. We'll thank very much for the panellists who gave up their time, for Pauline, for co-chairing. Lunch is on, and I believe that with lunch you can take it into the room for the panel session. Thanks very much.